Gerard, just taking a look at some of the headlines on the terminal this morning. Goldman stock traders head to record. Bank of America bankers and traders help earnings top estimates. And then finally, Citi notches gains across the board as trading outdoes expectations. It seems like trading and the big beats we're seeing there are definitely a theme this morning.
You're absolutely right, Katie. The investment banking and markets results were better than expected. You touched on it with the volatility. You might remember back in early August when there was some difficult economic data that came out, markets swooned for a very short period of time. That gave opportunities, obviously, for the trading firms to potentially benefit from that. In trading in markets in particular, volatility is a positive. And if you have some volatility, they normally can capture that with higher revenues, as you pointed out.
What about investment banking, Gerard? I mean, it seems like everybody's beating on those fees as well. Does that mean M&A is back? Does that mean these bankers are charging more money? What do you see in the investment banking landscape?
Matt, what we're seeing is that debt capital markets in particular were strong. We saw some of the banks indicate that after the Fed cut rates, yields fell in the capital markets area for the DCM market, and issuers captured and rushed out and issued debt. But to your point, the M&A advisory fees are also picking up, and I think there's evidence now that if the U.S. economy continues its growth, some folks were calling for a recession in 2024 or a year ago. That's obviously not happening. And so as industrials and corporates gain confidence that there's not going to be a recession, M&A activity could pick up even further, especially if the Fed continues to lower rates. It makes the financing of those M&A activities more attractive to the buyers.
Let's talk about net interest income as well, because we heard from Bank of America's CFO calling the quarter, quote, an inflection point on NII with it growing in the right direction. And maybe that's, of course, specific to Bank of America. But what is the overall narrative on net interest income? Because I thought heading into the quarter that we were expected to be underwhelmed there, but it seems like that hasn't been the case necessarily.
No, you're right, Katie. In a couple of banks, in particular, J.P. Morgan benefited quite nicely due to rising short-term interest rates, and they've pointed out that their net interest income is going to be challenged in a falling interest rate environment. But most other banks, including Bank of America, are actually well positioned to benefit from lower rates as we go forward into the end of 2025, as their deposits reprice faster downward than their asset yields. Now, that also is going to be driven by the fact that you're going to see maybe a pickup in loan growth next year. The banks have had modest loan growth in commercial loans in 2024. And we think that if the economy grows 2 to 2.5% next year, we get the final regulatory rules known as Basel III Endgame, where banks know where their capital levels need to be, and demand picks up for loans, we could see stronger net interest income in 2025 due to loan growth.
Hey, I wonder about the outlook for consumers, Gerard. I was looking at a chart just now showing credit card delinquencies just continuing to rise. Do you see that coming through in the bank's reports, and what are they saying about, the outlook in terms of the U.S. consumer?
What we're hearing from the banks on the U.S. consumer is that they're healthy. The net charge-offs, which are different than delinquencies, of course, for all the big credit card issuers this quarter, J.P. Morgan, Wells, Citi, Bank of America, they all declined sequentially, the actual credit losses. And so I think what you're seeing is that there was that surge in delinquencies about a year ago that filtered through to the charge-offs. Now we're seeing some stability in delinquencies. So we think that the charge-offs or the credit picture for the consumer is actually is resilient. I know there was some concern about Ally earlier in September about higher losses in auto lending. We're not seeing that with the commercial banks.